So UK interest rates have just gone up to 1%. Inflation could be hitting 10% by the end of the year. So what does all this mean for UK property prices? Well, in this video, I'm going to share with you my thoughts on the direction for UK property prices, supported with some compelling evidence and a clear set of directions on what you should be doing as property investors to actually benefit from the opportunity that this unique set of circumstances presents. So stay tuned.
Hi, my name is Ranjan Bhattacharya. I've been investing and developing properties for the last 30 years, so I've seen a few market cycles. You may have seen me on the hit Sky TV show Property Elevator, or you may have attended one of our Central London property meetups, the Baker Street Property Meet. If you're new to this channel, make sure you subscribe and hit the bell icon so you don't miss out on any of our videos. Be sure to like and also comment. Tell me what you think of what I'm saying here. Now, I regularly put out my market updates on what I think is happening to UK property prices, and so far I've been right pretty much all the time. Now, I'm going to draw a few things together which are currently playing out in the UK property market, and then I'm going to share with you some compelling evidence to support the direction I think property prices will go, and I'll also share with you the opportunity that is there for property investors like you who seize it and act now. Now, property price growth has been pretty good. We've seen near 10% year-on-year growth. That's not bad at all. And I think at the moment what's happening is that inflation and interest rates are ticking up. So there is a bit of concern as to what these new dynamics will mean for property prices going forward. Now, yes, interest rates are going up. They dropped to a record 0.1% during the pandemic. They now stand, though, at 1%. I believe interest rates will rise from this point. A lot of experts are commentating that they should hit 2 or maybe 2.5%. But that ain't too much to worry about, as I'll explain in this video. The reason why there's pressure to put up interest rates is, of course, the spectre of inflation. Now, high rates of inflation compounded year on year has a horrific effect. It has a horrific effect on the value of your earnings, and it also has a horrific effect on the value of any savings or wealth that you have. There is a way out, by the way. There's a way out to hedge against that inflation and also to get ahead of it, and I'll come on to that later in the video. Now, there's a lot of speculation right now as to whether property prices are going to crash, take a nosedive. And that's because in recent history, like in the 1990s, when interest rates nearly doubled overnight, that sent property prices tumbling. So there are some people that simply look at that correlation. They look at interest rates are rising, so that means that affordability is going to be an issue, and therefore property prices will come down. First of all, the Bank of England have very nicely put out a consultation paper on how they want to change the way mortgage affordability is actually calculated. You see, after the credit crunch and the financial crisis of 2008, banks were in trouble and the government had to bail out a lot of banks. And basically, pre the financial crisis, the banks had overlended. And a lot of those debts went bad. And that's why the banks got into trouble. So the government, or the Bank of England, basically said, look, we're going to have to put in some stress testing so that you don't overlend in the future. Now what the Bank of England are doing is they're saying, look, the banks are strong enough now, and some of the stress testing that we put in place after 2008, it was a little bit overkill for the current market, and they're looking at reining some of that back. So the long and short of it is, even though interest rates are rising a little bit, it won't affect mortgage affordability because the stress testing is getting slightly easier to compensate. Now, the big question is, how much will interest rates rise? Most of the experts predict that interest rates will end up being around 2 to 2.5%. Now, why are they putting up interest rates? Well, they're putting up interest rates because of inflation. Putting up interest rates is the only way to tackle inflation and to bring inflation down. The thing is, we've had times of high inflation, like in the late 70s. In the late 70s, we had high inflation. Then Margaret Thatcher came into power, raised interest rates, which had the effect of bringing down inflation. But the thing is, it also has the knock-on effect of inducing a little bit of a recession. So we had the same thing in the early 1990s when inflation started to raise its head again, and the then Chancellor Norman Lamont raised interest rates quite dramatically. Yes, it brought about a recession, but it cured the inflation problem, and it allowed for growth thereafter. Now, only by curing the inflation problem do you actually end up with a good decade of growth, as we experienced in the 90s and also in the 80s. Now, the thing is, I've put out videos about the reasons why, but inflation is rampant. They say it's 5%, they say it's going to increase to 7%, but do you really believe that? I mean, look at the inflation that you're experiencing with the basket of goods and services that you buy each month. Most people will say it's at least 12. We haven't seen those levels of real inflation in many, many decades. Now, the thing is, I don't believe this current government has the backbone to deal with inflation right now by putting up interest rates to what they need to be in order to curb it. Now, I think that's partly due to the fact that we have a general election in a couple of years' time, and no government in their right mind is going to put up interest rates to cure inflation and then bring about a recession slap bang in the middle of a general election, only for them to get voted out or booted out, and for another party to come in and basically ride the benefit of the growth that you'll get once inflation's under control. So inflation is going to be here with us for the next few years, maybe 3, 4, 5 years. So a lot of inflation in the economy is basically bad news. It's bad news for everyone, apart from savvy property entrepreneurs. Savvy property entrepreneurs can actually ride inflation to really, really get ahead and up their game. Now, I'm going to explain how to do that in a moment, but I want to share with you a little clip. This is a talk that I gave at last month's Baker Street Property Meet on the effects of inflation. And quite frankly, because we've had so little inflation over the last couple of decades, people don't realize the effects of just 4 or 5 years of the kind of inflation levels we've got right now. Take a look at this.
Inflation. Inflation over the last 20 years ain't been that bad. If you look at a basket of goods, and that's what they tend to measure it by, it's a basket of goods, how much have things gone up? So in the last 20 years, we've had about 69%. And the thing is, inflation is really dependent on what your basket of goods is. If you hate avocados, then you don't really care that they've gone up 38%. So it's down to you as an individual, and this basket is kind of on average. The other thing that happens with this basket is it's fiddled. And that is why we feel that the headline rate of inflation that we read about doesn't seem to be true. Headline inflation is 5.1%. They reckon it's going to be 7% by the end of the year. Who feels that prices are going up just by 5%? It's more than that, isn't it? And that's because of the way this is calculated. And this is an idea of how the inflation rate is fiddled. There's also what we call shrinkflation. Toblerone. Toblerone used to look like the diagram below. What they've done is they've kept the price the same, the package size is the same, but they've increased the spacing between the triangles. So they give you less chocolate for the same money. But in effect, the price has gone up. And they've done other things with this basket of goods. 20 years ago, for example, they used to talk about a loaf of bread, and it was brown bread. Now they've swapped it to white bread a few years ago, because that's slightly cheaper. And then how many slices make up a loaf? The number of slices in a loaf for the inflation figures is fewer than it was 20 years ago. So there's all sorts of massaging going on of the figures. So what do you think real inflation actually is? Anyone want to have a guess? I'm hearing a lot of figures, but I'm hearing a lot of double figures. I think it's around, I just feel it's around 12%-ish. And the thing is with inflation, and we haven't seen this since the 1970s. We haven't seen this since the 1970s. So people are very unused to dealing with a high inflation environment. So what we have had is this 68% of inflation in the last 20 years. If we're going to see around 12% inflation for the next few years, it only takes 5 years to rack up as much inflation as we've had in the last 20. That is the thing that we've got to kind of take into account that's actually happening right now. Because there's no solution to inflation. The real solution to, I actually watched, because we had all this in the 1970s. And while I was researching some of this, I saw a YouTube video of an interview with Ronald Reagan when he was going for an election I think he won in 1980 or something like that. And he was talking about the same problems. You know, the only way out of inflation cycle is to stop borrowing, is to reduce that borrowed money that's been printed and take it out of circulation so that the money is worth something. And there's no indication of that sort of thing happening. So inflation, the real issue right now is that over the next 5 years, we're likely to get the same inflation that we have had in the last 20.
If you're enjoying this video, smash the like button and also tell me what you think about what I'm saying in the comments below. Okay, so just to recap then, interest rates are rising, but they ain't going to raise them far enough to cure inflation. And inflation is quite rampant. And it's going to be like that for the next few years, particularly with an election coming soon. So what does that mean for property prices? Well, nothing gets away from the fact, of course, that we have a desperate shortage of property in the UK. We need 300,000 new homes every year. We're not even building half of that amount. But you see, the current inflationary cycle is actually exceptionally good news for savvy property entrepreneurs. Because in my investing career, which spans 30 years, I have never ever seen the circumstances that we have right now. Now let me explain what I mean by that. Let's just take a look at this graph. Now let's have a look at this graph of data from the Office of National Statistics going back some 30 years. Now the two coloured lines I want you to focus on is the CPI inflation rate, which is in black, and the Bank of England base rate, which is in pink. So I started investing in 1990, and we had a set of circumstances here where the interest rates were a lot higher. In the first decade or so where I invested in property, the interest rates were a lot higher than the inflation rate. And that differential means that through inflation alone, it's going to take a lot longer to inflate away the debt through rising asset values. So in that sort of environment, my strategy was to really look for motivated sellers willing to sell their property at a discount to market value. Through some of the time I was investing, property prices were actually falling. So you had to make sure you were buying below market value to secure yourself from the possibility of a fall in property prices. And then, of course, because of the high interest rates, you had to pursue a rental strategy which produced a lot of cash flow so that there's enough to cover the interest payments and produce a surplus. Since the financial crisis of 2008, for the first time, this whole thing has flipped on its head. And then, of course, it flipped. And it's hardly surprising if you look back through the data where there's the maximum difference between interest rates and inflation, where the inflation rates are far higher than the actual underlying interest rates. You see those are the times when we've had pretty good house price growth. And look what's happening now. As inflation touches, official inflation, should I say, touches 5%. Interest rates, yes, they're rising a little bit, but they're nowhere near enough to curb that inflation figure. And then, of course, the way inflation is measured has changed over this period, which is why we all feel that it's a lot higher than the headline rate. So what does that mean? When you have this differential where, just think about it for 1 second, the real rate of inflation is 4 times higher than the current interest rate. Now, for most people, this is devastating news. But for people that invest in income-producing property assets, which are leveraged, this is great news. And remember, you can see from this graph, there just hasn't been a time in history where this differential is widening so fast. So if you buy an income-producing property today, here's the thing. You may take out a £200,000 loan, but the value of that loan is frozen. So that £200,000 is what you pay back in 25 years' time. But if we've got real inflation and in excess of 10%, and we have it for at least 5 years to come, which I think we're going to have, then what is going to be the value of that debt that you're taking out? In just 5 years' time, it's going to erode in real terms. The mortgage serviceability will be pretty good because interest rates, as I said, they're a quarter of the real rate of inflation. And what savvy entrepreneurs are doing, of course, is fixing that rate of interest today. So you have that security of cash flow for 5 years. And let's look at that cash flow. In the last year, in some areas, rents have risen by 20%. And rents are likely to nudge up a little bit over the next 5 years, along with that inflationary cycle. So remember, if you're not into property, if you don't own property, or you're not going to do property right now, quite frankly, you're going to be stuffed by this inflation problem, unless you act now. That's a very bold statement I've made, so let me know what you think in the comments below. Also smash that like button. Now, if you do property in the right way meaning purchase income producing assets which are leveraged with debt, where you fix the rate of debt now for the longest time possible in the future. So this inflation problem, which will last at least 4 or 5 years in my opinion, is going to stuff everybody. It's going to stuff everybody who aren't already into property or are not planning on getting into property. But the people who do property, who buy income producing leveraged assets, will not only survive this, but they'll thrive it. When you buy an income producing property asset using debt, first of all, the positive cash flow helps secure, maintain and enhance your standard of living and face head on the spectre of inflation erosion. Buying that property asset in a leveraged way, using a deposit and the bulk of the money coming from the bank, means that the money that you do have, you protect. You protect the value in real terms. And because remember, if you're putting down a £25,000 deposit on a £100,000 property, it's the £100,000 property that's rising in value along with inflation. So that's a great way of protecting your savings and your wealth that you may have. And through leverage, you'll not just protect it, but you'll enhance it and outpace inflation and come out the other side smelling of roses. Now, as I said before, I don't recall a time in my 30-year property career where the stars have aligned so perfectly to make this a fantastic opportunity for purchasing leveraged income-producing assets. That is what we're going to be talking about at the next Baker Street Property Meet. The Baker Street Property Meet is the largest networking event for UK property investors. At our last meeting, we had over 300 property investors turn up to listen to presentations on some of the latest thinking in the world of property. So if you want to get ahead and do property in the right way, then come to our Baker Street Property Meet. It's on the last Wednesday of every month. The website is here, ticket availability is here, and you'll see me live there as well. So I'll see you at that. If you haven't already done so, subscribe to this channel, hit the bell icon so you're notified when we upload new videos. Catch you guys in the next video.
High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.